Welcome, traders and investors, to our video where we delve deep into the world of Fibonacci retracement trading. We'll be exploring the intricacies of this popular technical analysis tool. Join me as we uncover the truth about Fibonacci retracement and put its effectiveness to the test. Before we jump into our analysis, let's start with the basics. Who was Fibonacci? Leonardo of Pisa, or Fibonacci, was a 13th century Italian mathematician who introduced Hindu-Arabic arithmetic to the Western world. He is best known for his work on the Fibonacci sequence, a series of numbers that has fascinated mathematicians for centuries. The Fibonacci sequence, starting with 0 and 1, creates a pattern where each number is the sum of the two preceding ones. This sequence can be found in various natural phenomena, from tree branches to seashell spirals. Now, let's see how traders have applied these mathematical concepts to financial markets.
Fibonacci retracement is a technical analysis tool traders use to identify potential support and resistance levels. It draws horizontal lines on a chart at key Fibonacci levels. The idea is that markets may exhibit predictable patterns based on the Fibonacci sequence.
Traders use Fibonacci retracement levels to identify potential areas of support and resistance, aiming to enter and exit positions at key points in a trend. But the critical question remains: how reliable is this method? To test the efficacy of Fibonacci retracement, we conducted an extensive backtest on 102 stocks and indexes. Our methodology involved drawing retracement lines on charts covering the 2022 crash and recovery. We measured success by a 3 to 5 day reversal within 5% of the Fibonacci line. Our results reveal a startling 63% failure rate for Fibonacci retracement. Even the golden ratio of 61.8% did not show a higher reliability compared to other Fibonacci levels. The S&P 500 and Nasdaq 100 examples demonstrated the tool's inconsistency, making it less predictive than a coin toss.
Considering the 67% average failure rate, we strongly advise caution or complete avoidance of Fibonacci retracement. It is based on the self-fulfilling prophecy, where traders create support or resistance levels by using Fibonacci, but this only works if enough traders believe in it.
Many traders argue that Fibonacci retracement is not a reliable indicator due to its reliance on a mathematical pattern that may not consistently reflect market movements. External academic and industry papers provide mixed results on its effectiveness, highlighting the need for caution.
We've compiled a list of academic and industry papers exploring the efficacy of Fibonacci retracement. While results vary, it's essential to consider these findings when applying Fibonacci techniques to different markets and situations.
In conclusion, our thorough examination reveals that Fibonacci retracement is not a reliable trading tool, with a failure rate exceeding 60%. We recommend using proven indicators like the RSI, Heikin Ashi, the ROC, and VWAP for more reliable trading strategies. Remember, success in the market requires a cautious and informed approach. Thank you for joining us in unraveling the Fibonacci myth. Until next time, happy trading. Free and pro investing courses, strategies and original research at liberatedstocktrader.com.